Bhupendra Mantri ji.
Yes, we should start, sir.
Yes, sir. So, respected speaker of from the past 2 days, Bhupendra Mantri has taken a lot of pains. Today is also third day. So, I welcome you, Bhupendra Mantri ji. This is Accounting Standards virtual seminar. And Secretary of the branch, C.A. Anil Banpal, and past chairman of the branch, my senior professional colleagues, MC members, I welcome you all for this today's virtual seminar. Because we all know that accounting standards lay down sound principles for recognition, measurement, presentation, and disclosure of information in the financial statement, which substantially improve the quality of the financial statements. So this is more important. So this 21st century economic and business scenario demands a differential approach in the standard setting and implementation of the standards. Because one size fits all, no more considered viable approach. Accounting standards areas is no exception to this phenomenon. Recognizing the challenges and unique features of small and medium practitioners of the and enterprises, needs has been felt to enhance the spectrum of tools and modes of guidance to this critical set of stakeholders. My dear friends, you all know from the past 2 days, we have discussed the revenue recognition, property, plant equipment, and construction of the calendars. Other than these assets, the remaining assets, like valuation of inventories, impairment of loss assets, contingent assets, and other assets, today we will discuss by Bhupendra Mantri ji will discuss in detail, and he will depict all the assets in detail. So we will learn, and wherever you will get doubt, you please raise your hand because he will clarify all your doubts. So with this short, so welcome you all once again. A good evening to all of you. So now I request Bhupendra Mantri ji to address the members.
Yeah, thank you, sir. I will be just sharing the screen and then will start my presentation. So my screen is visible to all.
Yes, sir.
Yeah. So today, in fact, I will be discussing various accounting standards related to assets other than property, plant, and equipment. And so far, these standards are concerned, which I have to cover today, are first is the inventory. Then another standards are your government grant, accounting of government grant, because there also sometimes we receive the assets. Then accounting for investments. So third standard, which I shall be dealing with, the accounting for investments. Then AS 19 on leases I will be dealing with, and then AS 26 on intangible assets. So these are the 5 standards, considering the overall time of say 2 hours and odd. I will be dealing with these 5 standards, but at the same time, if there are any query with reference to any other standard, I will be trying to answer that also. And if there are any queries in between my presentations, then I would again request you all to please raise your hands so that I can invite you for raising that queries, and we can resolve, and then interaction will also become more interactive. Uh, so with this, I would start my presentation over here. Uh, so please confirm that the slide is moving. Yeah.
Yes, sir. Yes, sir.
Okay. Yes. So now first I will be taking up the accounting standard 2 on valuation of inventory. So first of all, if we consider the scope of work, then this accounting standard does not apply to the work in progress of the construction contracts, which we have discussed yesterday, then any other directly related service contracts. So there this accounting standard is not applicable. Then WIP in the ordinary course of business of the service providers. So there also this standard is not applicable. Then financial instruments, that is these investments which are held as stock in trade. So there also this accounting standard is not applicable. Then any producers inventories of livestock or mineral and agricultural, etc. To the extent these are measured at NRV as per the practice in the industry. So generally these livestock, minerals and agricultures, they are actually valued at NRV. So as per the respective industry of the practice of the industry. So these are not covered over here by the AS2. So what are inventories? So inventories are the assets which are held for sale in the ordinary course of business. So first of all, those inventories, those assets which ultimate objective of the company, of the entity, is to sell them. So that is inventory, or which are there in the process of production for such sale. So any raw material, any work in progress, that is also the industry, that is also the inventory, which are actually used for the purpose of production of the finished goods, which will be ultimately sold by the entity in the market. And then any asset in the form of materials or supplies to be consumed in the production process or rendering services. So then there are various items apart from the raw material, finished goods. Then there are various items which are actually used. Say there are stores and spares, consumables, as well as certain packing material. So these are the items which are used in the form of material or supplies in the, as well as for the purpose of consuming the same in the production process. So therefore these are also the part of inventories. So this is the definition of inventory. Then how do we measure the inventory? The simple principle of measuring the inventory is it should be valued at lower of cost and net realizable value. So every time when you actually value the inventory, or you need to state the inventory in the financial statements in current asset side, then as an accountant or as an entity, one need to consider that what is the net realizable value of a particular inventory. And basically if we go to the definition of net realizable value, it is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make that sale. So that is the net realizable value. So inventory is required to be valued at lower of cost or such net realizable value. So for the purpose of valuing the inventory, one should always see whether net realizable value is available or not. And if not available, then one should try to ascertain that what is the net realizable value, and then accordingly account for the same. If it is lower, then NRV should be restated, and if it is higher, NRV is higher, then uh, cost should be stated as inventory in the financial statements. So then what is the cost? Cost of inventory is here like aggregate cost of the purchases plus conversion plus other expenses which are incurred in bringing the inventories to the present location and conditions. So this is important. Suppose one is purchasing the traded goods for the purpose of trading. So in that case, only the cost of those goods which are purchased and they are meant for the sale directly without any conversion, then cost of that goods will be the cost of inventory. Those goods will be the cost of inventory because there are no conversion cost involved. Plus, if there is any freight expense which are paid by the entity for the purpose of bringing those goods either in the godown of the entity or to any other place of the entity. So those freight expenses will also be included in such traded goods. Apart from that, any expense, suppose any company is engaged in the manufacturing. So in case of manufacturing, all cost which are related to the conversion of goods, conversion of raw material into the finished goods, shall also be the part of cost of the inventories. So such conversion may include a lot of expense which are being incurred while processing the raw material. These expense may be, say, running of plant and machinery, maintenance of plant and machinery, electricity expenses incurred for running the plant and machinery, any depreciation cost which has been incurred for the plant and machinery, any direct labor expense which are incurred for the purpose of converting the inventory into the raw material into the finished goods, any other consumables which are used. So all these items are basically treated as conversion cost, and same should be part of the inventory. So net realizable value I have already discussed. Now coming to the cost formulas, that how the value of the inventory should be arrived at, then standard suggests that either there should be a specific identification method, and such method should be used generally for those items which are not ordinarily interchangeable and goods are produced for specific projects. So therefore, suppose there are some specific projects for which certain inventories have been purchased by the entity, and all these inventories are always identified. That's yes, this was the inventory which was actually purchased at this particular rate at this particular price, and the same is lying with the entity as on the reporting date. So there is a specific identification that from where the particular inventory have been purchased and whether if the same is lying in the stock same is lying in the overall quantity, then at what rate that particular inventory have been purchased, on that rate, on that value, it's only the cost of inventory should be determined for the purpose of valuation as per this accounting standard. Then another method is your first in first out method, that is called FIFO, or it may be weighted average method. So one should always see, wherever, suppose there are always inventories which are interchangeable, which cannot be identified, which once received are actually put into the pool of the inventories at one place, and no identification is being maintained by the entities. So in such case, the FIFO method can be used, and another method which can be used is the weighted average method. And in fact, weighted average method is more suitable method, but nowhere one should use the LIFO method, that is last in first out, because LIFO method will not give a correct picture of the value of the inventory. And for the purpose of calculation of the weighted average method, one should actually see, because many times when any ERP calculate the weighted average method, then one should always see that that ERP has the all relevant records on timely manner or not. Because many a times, suppose the relevant entries are not done timely in the ERP or in any other software where companies are maintaining their books of accounts, then if one will calculate the inventory as per the weighted average method, then that will be probably not a correct weighted average, because entries are not recorded timely in the books of accounts. The formula used should reflect the fairest possible approximation to the cost incurred in bringing the items of inventory to their present location and conditions. And then the techniques such as standard cost or retail method may also be used for convenience if it approximates the actual cost. So here I will basically explain this standard cost example with one of the by a next slide. But before that, we shall also discuss that what is the cost of purchase. So cost of purchase consists of the purchase price, including duties and taxes, other than those subsequently recoverable by the enterprise from the taxing authorities. So if any, suppose input tax credit is available to the entity when any purchase is made, then that input tax credit will not be treated part of cost of the inventory. Then any freight inward and any other expenditures which are directly attributable to the acquisition. So that is the cost of purchase. Then any trade discounts, rebates, duty drawback, and other similar items are deducted in determining the cost of purchase. So any such expense which is being any such rebate or discount which is being received by the entity should be actually reduced while determining the cost of the purchase. Then next is what is cost of conversion. I have already explained in detail. So any fixed overheads should be part of the inventory, and it should be on the basis of normal production capacity. So this I will also again how it will be actually allocated. Then any amount of allocation is not increased as a consequence of low production or idle plant. Then amount of allocation is decreased in case of abnormally high production. So this entire slide I will explain in my next slide. Then any variable overheads on the basis of actual use of the products and facility, that should also be included. And if there is any joint products, any byproducts, when cost not separately identifiable, then allocation is required to be on the basis of rational and consistent basis. That is on the basis of the sale value of such joint products and byproducts. So now coming to the one example related to the fixed overheads. So here I have given an example, and then there are three situations that how a allocation of fixed products and overhead will be there while computing the cost of the inventory. So suppose there is total depreciation on plant and machinery or factory building of rupees 1 lakh. Then there is staff administrative expenses, which forms part of the inventory, is rupees 1 lakh. So total expenditures are say rupees 2 lakhs. And the normal production as per the production capacity of the enterprise of the entity is 1 lakh units. So in that case, the allocation of fixed overhead would be at rupees 2 per unit to the value of that particular inventory. But here I have given the three examples. So suppose actual production is only 50,000 units. So in that case, the value of the inventory per unit will not, allocation of fixed overheads for per unit of inventory will not be rupees 4 per unit. Rupees 4 means the total expenditure is rupees 2 lakh divided by actual production of 50,000. So this rupees 4 per unit is not the correct allocation. What is the correct allocation is rupees 2 per unit. That is the standard cost which is there for per unit, which is 2 per unit. So even if the overall value is rupees 4 unit, because of the lower production of 50,000 units, such rupees 4 will not be considered for the purpose of valuation. Only rupees 2 will be considered. But suppose actual production is 2 lakhs, that is higher than the normal production capacity of the company, of the entity. So in that case, the actual expense is rupees 1 per unit. Actual fixed production overhead is rupees 1 per unit. So in that case, the allocation will not be based on the normal production capacity. Since production is higher, the actual allocation will be based on that higher unit of production. So that will come to rupees 1 per unit. And suppose actual production is 1 lakh unit, that is as per the normal production capacity, then yes, rupees 2 per unit will be allocated of this production, fixed production overheads. And in the trading and profit and loss, since we have done in the first situation, we have done the allocation of rupees 1 lakh, the balance rupees 1 lakh will be charged to expense as a loss in the profit and loss statement. And in the second situation, there will be no profit or no loss in the profit and loss account, because entire rupees 2 lakh has been allocated to the cost of inventory. Then in the third situation, again, there will be no profit, no loss, because entire rupees 1 lakh has been allocated, entire rupees 2 lakh has been allocated to the cost of inventory. So this is how these fixed production overhead are required to be calculated, are required to be allocated as per the AS2. Now, what are the exclusion from the cost? So exclusion from the cost. So generally interest and other borrowing cost will not be included in the cost of inventory. So if your inventory is not a qualifying asset, so I would come to the qualifying asset criteria. But inventory is not a qualifying asset, it takes say 1 month's time to produce the inventory, and for that, suppose any working capital has been taken by the company. So in that case, any interest expense paid on such working capital will not be forming part of the inventory. But suppose there are certain inventories which takes substantial period of time. Inventories like real estate assets, which may take even more than 1 year in the construction. And then there are certain other industries wherein inventory take more than 1 year, like inventories of rubber industries or inventories of your wines. So these industry take more than 1 year in producing the inventory. So any borrowing taken for the purpose of manufacturing such inventories, any interest cost on such borrowings may be part of the inventory. And apart from that, any abnormal amount of wasted material, labor, or expense. So suppose any inventory is being constructed, but at the same time, apart from the normal material, labor, expense, suppose any additional expense is being incurred on the material and labor. So then additional expense should not form part of the inventory. That should actually directly charge to the expense. So one should always see that while producing the inventory, is there any additional wastage apart from the normal wastage? So suppose during the course of manufacturing itself, certain raw material, because of the any negligence on the part of, say, labor, or on the part of or for any other reason, for any natural reason, suppose the raw material becomes waste. So such wasted raw material cannot form part of the cost of the total inventory which has been produced by the company, by the entity. So that is how one need to consider. Then storage costs should not be included in the inventory unless these storage costs are necessary in the production process. So one need to consider whether such storage cost is necessary for the production process. If it is not necessary, then it should not form part of the inventory. Any administrative overheads which is not contributing in the bringing inventories to the present conditions. So any other expense which are general overheads should not also form part of the inventory, or any selling and distribution expenses should also not be forming part of the cost of the inventory. So all these costs are required to be excluded from the while computing the cost of the inventory. So now these are the disclosures. But before going to the disclosure, one thing I would like to mention about the net realizable value. So how to calculate the net realizable value in case of a manufactured goods, or in case of raw material where goods are actually manufactured. So standard says that suppose a raw material is being purchased at rupees 100, and overall, while selling the finished goods, if there are profits to the company, so overall, if there are profits while selling the finished goods, then in that case it will be assumed that net realizable value of the raw material is higher than the cost which has been incurred by the end. But suppose any finished goods are sold in the market at lower price or at loss, so in that case entity need to consider, if it is sold at loss, entity need to consider whether there is any decline in the net realizable value of the raw material also. And if it is so, then entity should recognize the net raw material at NRV, which is actually lower than the cost incurred by the entity. So now coming to the disclosures. So accounting policies, one should disclose the accounting policies adopted in measuring the inventories including the cost formula, then the total carrying amount of the inventories and its classification appropriate to the enterprise. So these are the disclosure requirements. And then in notes, these are the various classifications which are required to be done. Raw material, WIP, finished goods, store and spares, and loose tools. So these are the major heads of line items which are required to be disclosed under the inventory. So with this, I have certain queries on the inventories for which I would like to have answers from the participants. So my first query is the company has four. Hello. Yeah. The company has 4 area offices in the country. Under each of them, 1 minute. Yeah. The company has 4 area offices in the country, and under each of them, there are a few regional offices, each of which operates a few agro service center, whether freight incurred for transportation of goods from factory to the field godown of agro service centers should be included in the cost for the purpose of valuation of inventories held in the field godowns. So anyone who would like to answer this? Hello.
శ్రీనివాసరావు గారు చెప్పండి.
Yes, sir. Yes, sir. Hello. Yes, Chairman, sir. Anyone who would like to answer, because I am not able to see if anyone has raised the hands. Hello. Yeah. So probably
everybody is having a doubt about this, whether to be included or not.
Are they have the doubt? So anyways, so I would actually explain this query and answer to this query. So here they says that see, for the purpose of inventory, valuation of inventory or computing the cost of inventory, the criteria is that those costs which are incurred for bringing the assets, bringing the inventory into their present location and conditions as intended by the management, that it can be sold out. So here, from factory to the field godowns, so this is a necessary expenditure which is required to be done, because until and unless the goods will not be moved from factory to the field godowns, it cannot be sold. So therefore, any expenditures which has been incurred on transportation of goods from factory to the field godown should form part of the cost of the inventory. So that is the answer to this. And suppose these expenditures are transportation expenditures are incurred from agro service centers to the customer's location, for sending the goods from agro service centers to the customer's location. So whether such transportation costs should also be included in the cost of the inventory? I am sure that now everybody can answer this. So basically, such expenditure is a selling and distribution expenditure. So from sending goods from agro service. Hello, yes. From
Okay,
agro, yes, Chairman, sir.
No, you carry on, sir. Carry on.
Yes, yes. So from agro service center to the customer location, that will not be part of the cost of the inventory. because these are actually the selling and distribution expense. Now coming to the another query. So one of your client who is basically manufacturing or who is basically a power generator, the coal is a significant raw material which is handled and processed at various points, that is from loading point of mine to the power plant, and crushed before firing in the boilers. Your client wants to value coal in stock at the end of the year to include not only the coal price, but also the cost of transporting and handling the coal within the factory and crushing it before it is finally fired in the boilers. So advise your client whether he is correct or not in including the cost of transportation and handling within the factory premises. So anyone who would like to answer?
Members, please.
So here again, these expenses are incurred for bringing the inventories into their present condition and locations as intended by the management, so that it can be actually it can actually help in producing the electricity. So whatever coal is there at the year end, if any expenditure has been incurred in such transportation and handling the coal, should also be included in the cost of the coal. So that is the answer to this particular query. So now coming to the next standard, that is accounting standard 12, accounting for government grants. So I'm sure that all of our clients keep on receiving the government grants from the government. So this standard is more or less being in day out used by all our clients. So ACE 12 I shall be discussing now. And before that, if anyone has any query with reference to ACE 2, we can deal with those queries. So Chairman sir, if there is any query from ACE 2.
Members, any queries regarding the valuation of inventories, that you can raise your hand, or you can unmute yourself and ask, because he has clearly and explained the valuation of inventories step by step, average cost, standard cost, everything he has explained. How to go for this one, whether weighted average or first in first out method, everything he has discussed. If you are having any, you want any clarification, that you can ask. Members, please. If you are not having any doubts regarding that topic, that will go to the second accounting standard 12, that is accounting for government grants. Sir, we will move, sir.
So I will move to the AS 12, accounting for government grants. So AS 12 deals with the accounting for government grants such as subsidies, cash incentives, duty drawbacks, and specifies that government grants should not be recognized until there is reasonable assurance that the enterprise will comply with the conditions attached to them and the grant will be received. So this is in some nutshell, this is the summary. But this standards does not deal with the special problems arising in the accounting for government grants in the financial statements, reflecting the effect of changing prices or in supplementary informations of a similar nature. So suppose if any asset is being accounted for under the government grant and later on there are certain changes. So these things are not being dealt with by the standard. Then in government assistance, other than in the form of government grants. So many times issues are there related to, say, exemptions related to the income tax. So that is also a kind of government assistance. But such exemptions which are being given under the income tax laws and are actually not being dealt by this standard. So simply whatever tax liabilities are being there after considering that exemption are calculated by the company, and accordingly the tax liabilities are accounted for. So such assistance in the form of tax exemptions, etc., are not considered by this particular standard. Then government participations in the ownership of the enterprise. So almost all government companies keep on receiving the equity from the government. Maybe it is state government enterprise or any CPSU, central public sector undertakings. So if any equity is being received as a participation in the ownership of that enterprise, so such equity receipt is also not considered by this particular standard. Now coming to the meaning of the government grants. So government grants are basically assistance by the government in cash or kind for past or future compliance of the certain conditions. So basically, when you receive any amount from the government in cash, or any kind of, say, any asset is being received in kind for any of the work which you have done, or any of the work which you may do in the future. So then that assistance is actually treated as a government grant. And here the government includes any government agencies. So any, say, municipal corporations or any other government agencies, any government department. So these are also considered as government. And then your state governments, your central governments, these are also the governments. Then importance in the financial statement. Why accounting of government grant is important in the financial statement? Because suppose any income is being received, then it will facilitate the comparison with the other enterprise. Suppose other enterprise have not received the government grant, the reporting enterprise which we are dealing with is received the government grants. So that will actually facilitate the comparison between the two. That yes, income of this particular enterprise is higher because of receipt of the government grant as against the other enterprise. And then the similar comparison may also be there with the prior period, earlier period results of the company. So it is very important to actually account for the government grant properly in the books of accounts. And then recognition of the government grant. So it should not be recognized until there is reasonable assurance. So this I will discuss later. First of all, that what should be the accounting treatment of the government grant. So basically there are two approaches which are being given. One is capital approach and another is income approach. So as per the capital approach, accounting is being done generally if such grant is in the nature of promoter's contribution. So many a times we see that the government gives the grant to either to the state PSUs or sometimes to the private sector enterprises also, by specifically saying that it is in the nature of promoter's contribution. So if it is so, then such promoter's contribution should be treated as capital reserve, and it should not be taken to the profit and loss statement. And then it is also assumed that those who are supporter of the capital approach, they assume that these grants are not earned, but they represent incentives without any cost incurred. So if this is the case, then it is accounted for under the capital reserve, under this capital approach. And those who follow the income approach, who say that grant should be recognized as per the income approach, in that case, any grant which is being received in the cash or in the kind should be accounted for in the profit and loss account as income. And it is assumed that no grant is being received by the enterprise without making any efforts. So it is not a gratuitous grant. So basically, one need to make the efforts, one need to make certain compliance of the conditions. So then such grant are being received by the enterprise from the government. So therefore, such grants should be charged to the or should be accounted for in the profit and loss account. And the another thinking behind this is that as and when any government levies in the form of GST, income tax, etc., are being paid to the government, so when that is charged to the profit and loss as expense, then grant which is being received from the government should also be accounted for as income. And third argument in support of the income approach is that uh, for for the grant we need to also incur certain expenditures. So for a proper correlation between the expenditure incurred to which this grant relates, the grant should be actually accounted for uh, as income. However, it should be based on the nature of each grant, whether it should be accounted for as capital approach or it should be accounted as per income approach. So it should always be depending on the nature of the grant. And uh, such grants should always be accounted for on a systematic basis as per the income approach, and sometimes basis the cost or other related in expense incurred. So as and when any cost or expenses are being incurred, then this grant should be accounted for as income. So only on the basis of receipt of the grant, it should not be accounted for as income. One should see that receipt of the grant may be even in advance, but later on expenses related to that grant, if they are incurred at a later point of time, then such grants should be accounted for at income as and when such expenditure are incurred. So when one should recognize the grant, the principle are given in the AS12 that it should not be recognized until there is reasonable assurance of the compliance with the relevant conditions for receipt of such grant. So first condition is that for the purpose of receiving the grant, whatever conditions are there, the entity is reasonably assured that yes, all respective conditions will be complied by that entity. Suppose there is any doubt, or suppose there is any possibility that the relevant conditions will not be complied with, then even if the grant is received, the same should not be accounted for as income. So that should be such assurance. And then the another assurance is that there will be ultimate collection of that grant by the enterprise. So if both these conditions are satisfied, then only the grant should be recognized as in the books of accounts as income. So this is the recognition principle with reference to the grants. Now coming to the grants which are related to the specific fixed assets or specific property, plant and equipment. So if grant is related to any specific property, plant and equipment, then it should be deducted from the gross value of the assets. So that is the one option, that whatever grant is being received, suppose the total cost of the asset is 1 crore and 50 lakh has been received by the government, from the government by the enterprise, then the grant, the value of the gross value of the property, plant and equipment should be accounted for at rupees 50 lakh only after deducting the grant received from the government. And if that grant is equal to the cost, suppose overall cost is the entire cost is being reimbursed by the government, then that asset should be recorded only at a nominal value. And then there is an alternate option also for accounting for such grant related to the specific property, plant and equipment or specific fixed assets, wherein the grant should be treated as deferred income on a systematic basis over useful life. So for depreciable asset, if it is a depreciable asset on a systematic basis, the grant should be accounted for in uh, accounted for uh, on systematic basis in the profit and loss statement, and generally it is accounted for in proportion to the depreciation which is being charged. So suppose so ultimately the impact on the profit and loss would be same as per the first option, because in the first option the depreciation is charged on the net value after deduction of the grant from the gross value. So automatically the depreciation is charged at a lower rate. In the second option, uh, 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 there is a deferment of income wherein the grant is recognized as income on systematic basis. And since the property, plant and equipment is stated at higher amount without considering the value of the grant, so therefore there is higher charge of depreciation on such property, plant and equipment. So in nutshell, on the profit and loss statement, because of the both of the accounting treatment, there is no impact, because the grant is accounted for in proportion to the depreciation which is being charged to the profit and loss statement. And for any other grant, it should be directly to the capital reserve. Suppose there is any grant related to the land, which is actually not a depreciable asset. So in that case, such grant related to the land should be taken to the capital reserve. However, if require fulfillment of the obligations, then be credited to the income over the matching period. Suppose there are still certain obligations which are required to be completed with, then in that case, the grant should be accounted for with the fulfillment of those obligations on regular basis. So as and when obligations are fulfilled, the grant should be accounted for as income. So for revenue grants, it should be recognized on systematic basis in the profit and loss, either as other income or deducted from the related expense. So suppose any grant is being received on account of certain expenses incurred, so the company may also account for such grant into those expense itself. So expense can be netted off. If receivable as compensation for expense or loss of preceding year, or as immediate financial support, then one should also consider that the same should be disclosed as extraordinary item or not. Suppose certain expenditures are incurred in the previous year or losses are incurred in the previous year, and then thereafter, because of the certain schemes of the government, such reimbursement is there in the subsequent year. So such grant should be accounted for as extraordinary item. The company, the entity should judge whether the same should also be disclosed as extraordinary item or not. The promoter's contribution, it should be taken to the capital reserve, as already been explained. Then assets which are at concessional rate or at non-monetary, then it should be accounted for at acquisition cost. And suppose if it is at free cost, then it should be accounted for at nominal value. So these are the certain recognition principle. Then if grant becomes refundable, so many times because of non-compliance of the conditions or because of breach of certain conditions, the grants which has been received by the companies, by the entities, may become refundable. And if it is so, then it should be treated as an extraordinary item depending on the materiality of a particular item. Then if it is revenue in nature, then it should be first applied against the available amortized credit balance. So suppose any of the amount which has not been accounted for as income and is being shown as under the liability, because as I said that certain revenue grant should be accounted for as income, as deferred income over a period of time. So suppose any amortized balance is there, then if it becomes refundable, then as and when it is refundable, it should be refunded, it should be adjusted with such credit balance. And suppose there is no credit balance lying in the books of accounts, then whatever grant becomes refundable should be charged to the profit and loss statement. So as and when, so it is not only when it is actually refunded, as and when it becomes refundable, it should charge to the profit and loss statement. And if it is related to the fixed assets, then one should increase the book value or reduce the capital reserve or defer income, as the case may be. How and accordingly the depreciation charge will also be there on the will change on the prospective basis for such grant. And if it is in the nature of promoters contribution, then there is to be reduction from the capital reserve. So this is about the refund of the grant. And so far as disclosures are concerned, accounting policies adopted, including the method of presentation, should be disclosed, and nature and extent of government grant recognized, including non-monetary asset given at the concessional rates or free of cost, should also be disclosed. So here is one query related to the government grant. If anyone can answer. A limited company has set up its business in a designated backward area, which entitles it to receive, as per a public scheme announced by the government of India, a subsidy of 15% of the cost of investment. So having fulfilled all the conditions laid down under the scheme, the company on its investment of rupees 100 lakh in the capital asset during its accounting year ending on 31st March 2022 received a subsidy of rupees 15 lakhs in January 2022 from Government of India. The accountant of the company would like to record the receipt as an item of revenue and to reduce the losses on profit and loss for the year ended 31st March 2022. Is his action justified? So anyone from the participants, if they can answer. Yes. So Chairman sir, would you like to answer? Yes, Mr. Srinivasa.
I think it should be transferred to the capital reserve, since it is investment against the capital contribution. So incentive received or grant received for the investment made, so that should be transferred to the capital reserve instead of reducing from the losses.
But see, this is basically for the purpose of cost of investments. Yes. So for all capital assets, this has been received. So as I said that there are two ways. One is either to reduce it from the cost of the capital asset. So this 15 lakh rupees will be reduced from the capital asset. Then accordingly, the depreciation will be charged at a lower rate. Or it can be treated as deferred income, which will be proportionately be charged to the income over a period of useful life of that particular asset. So this is how one need to deal with this particular query.
So on this context, I have a question, sir.
Yes, sir. Yes.
So instead of loss, let us assume that there is a profit. So company has received 50 lakhs as a grant, as a revenue grant or investment grant. Can it be used for distributing a dividend?
Okay. So you are saying that if it is for capital reserve, then though it is a company location, but I think suppose you have received it from the government, and once it becomes part of your financial statement as reserve, so probably there should not be any restriction under the company law whether distribution of dividend can be there or not from out of this reserve.
Okay.
Yeah, I think company law do not have any such restriction to
Sir,
be. Yeah, but still I am not very sure because it is a
Sir.
company law. Yeah, yes, sir.
Companies Act makes a specific restriction on declaration of dividend out of capital profits. So if this subsidy, if it is considered as a capital receipt, so distribution of any dividend out of this subsidy.
So, sir, basically there are two ways of treating this particular standard. So here I am not treating it as capital reserve. I am treating it as a deferred income, and
Then
I will be
in that case, to the extent of the amount which has been credited to profit and loss account,
yes, so can be considered for the purpose of
so
dividend.
whatever is credited to profit and loss account is considered as profits otherwise available for distribution
Correct,
to
correct, correct. So to the extent of deferred income,
exactly.
it should not be considered part of profit for the purpose of distribution of
To the
dividend.
extent of income credited to profit and loss account,
Correct.
that those profits will be available for distribution.
Yeah. So thank you, sir. Now coming to the any other query on the government grant standards?
Members, please, if you are having any doubt or any clarification, or you want to share any information,
So I am coming now coming to the next standard, that is on accounting for investments, AS 13. So AS 13 does not deal with the basis for recognition of interest, dividends, and rental earned on investments, which are covered by AS 9 revenue recognition, which we have discussed yesterday. On any operating or finance leases, it does not deal with that. Then investment of retirement benefit plans and life insurance enterprise. Then mutual funds and venture capital funds and related asset management companies, banks, and financial institutions. So yeah, these are the certain definitions which are there as per the AS 13. So investments are basically the assets held for earning income, capital appreciation, or other benefits. And stock in trade is not the investments. Then current investments are defined as investments readily realizable and is intended to be held for not more than 1 year from the date of making such investment. So generally there is an intention that the investments so made by the enterprises, by the entities, will be sold within a period of 1 year. So such investment will be accounted for, will be treated as current investment for the purpose of this AS. And then long-term investments are investments other than the current investments. So if any investment is not classified as current, then it will be classified as long-term investments. Then investment properties are the investments in land and building, or land or building that are not intended to be occupied substantially for entities' own use. So that is the investment properties. So in AS 13, only one para is there related to the investment property. But in Indian accounting standards, there is one complete standard on investment property. In AS 40 is there. Then what is market value? Is the amount of net of expense which is obtainable from the sale of investment in the open market. So that is the market value. So what is cost of investment? We can discuss is the cost which should include the any acquisition charges. Suppose while apart from the cost, if there is any acquisition charges, any brokerage or any fees which has been paid for acquiring such investment, so that that should form part of the cost investments. If it is acquired in exchange of shares or securities, then the fair value of such shares, securities should be taken as cost. So whatever shares and securities you have given for acquiring the investments, the fair value of such share and securities which are given should be considered for the purpose of cost of the investments. Then if it is acquired in exchange of any other assets, then the fair value of those assets which is more clearly evident should be taken as cost. And then any interest, rental, dividends are generally income. Whatever interest, rental or dividends which are received are generally income. But suppose such interest or dividend is related to the pre-acquisition period, then it may be basically considered as recovery of the investments instead of treating them as cost of investment. So these are the basically principle for accounting of the investments. So investments, current investments are generally measured at lower of cost and the fair value of a particular investment. So basically the standard suggests that the comparison of cost and fair value should not be on global basis. Suppose there are total 10 type of investments, and the cost of such all investment is, if compared with the fair value of all investment, then the cost is higher. Then while comparing, one cannot say that on global basis it should be accounted for. So even the standard suggests that the most appropriate method of comparison of cost and fair value is on individual investment basis. So even if one want to make the comparison on category wise, suppose equity shares are categorically compared with the costs are compared with the fair value. So even that is not suggested, though it has been written that the entities may do this, but the appropriate method is to do the cost on the individual to individual investment basis. And then wherever the cost is higher as compared to the fair value, then the provision for such reduction in the value of that investment should be made in the books of account. Then long-term investments, instead of their value, fair value, should be accounted for at cost only, not at the fair value. Sometimes the fair value of such long-term investment may be even lower to the cost, but since it is long-term investment, no provisions should be made for such lower fair value until and unless such value is permanent in nature. So suppose there is permanent diminution in the value of decline in the value of the investment, long-term investments, then only the value, then only the provision should be made. And if the change in the value of the long-term investment is temporary in nature, then no effect should be taken for such change. So any reduction or any reversal of the reduction in the carrying amount should be either charged or should be credited to the profit and loss account, or on disposal, any surplus or any deficiency, any deficit which is there should also be credited or charged to the statement of profit and loss account. On disposal of investment, the difference between the carrying amount and the disposal proceeds net of expense is recognized in the profit and loss statement. So as and when it is being sold, whatever is the difference between the carrying amount as well as the proceeds which are received should be charged to or should be credited to the profit and loss account, gain or loss. And when disposing of the part of the holding of an individual investment, the carrying amount to be allocated to that part is to be determined on the basis of average carrying amount of the total holding of the investments. So as and when suppose there are 1,000 shares which are being there and 500 have been sold, so the remaining 500 should be carried at the average cost. Then if there is any reclassification of the investments, so where long-term investments are reclassified as current investments, then transfers are made at lower of cost and carrying amount at the date of the transfer, and any difference is being taken to the profit and loss. And where investments are reclassified from current to long term, then also transfer are made at the lower of cost and fair value at the date of the transfer. These are the various disclosure requirements. The accounting policies followed for valuation of inventories, investments should be followed. Then amount included in the profit and loss statement for interest, dividend, showing separately dividend from subsidiary companies, and rentals on investments showing separately from such long-term and current investments. Gross income should be stated. The amount of income tax deducted at source being included in the advance tax paid should also be stated. Profit and loss on disposal of current investments and changes in the carrying amount of such investments should be stated. Profit and loss on disposal should be stated. Significant, if there are any significant restrictions on the right of ownership, realizability of investments, or the remittance of income and proceed of disposal, so that should also be disclosed over here. And then aggregate amount of the quoted and unquoted investments, giving the aggregate market value of the quoted investments should be disclosed, or any other disclosures as especially required by the relevant statute governing the enterprise. So in case of investments, Schedule 3 of the Companies Act specifies various disclosures. So the disclosure should also be there according to the requirement of Schedule 3 of the Companies Act, wherein various category-wise investments in India, outside India, such disclosures are there as per the Schedule 3. So those disclosures should also be there in the financial statements. Now coming to one of the two of the queries which are there. So query 1 is, explain in brief as to how you will deal with the following as the auditor of the company. A government company on the directions of the central government had made investments in the shares of certain other companies. During the accounting year ended on 31st March 2022, the company sold some of those investments at a profit of rupees 40 lakhs and treated the same as revenue profit for the year. The value of the remaining investments held as on the date of balance sheet as on 31st March 2022 had fallen by rupees 36 lakhs vis-a-vis cost thereof, for which no provision has been made in the accounts. So anyone who would like to answer this particular query? Chairman, sir, anyone?
Sir, members, because the query 1 clearly says that explain please as to how you will deal with the following as the auditor of a company. A government company on the directions of the central government, because as per the direction of central government had made the investments, the shares of certain other companies during the accounting year ended 31st March 2022. The company has sold of those investments at a profit of 40 lakhs and treated the same as revenue profit for the year. The value of the remaining investments held as on the date of the balance sheet as on 31st March 2022 had fallen by 36 lakhs vis-a-vis the cost thereof, for which no provision has been made in the accounts. Because as per my view, the provision has to be made and the entire profit should not be taken into the, if you take the profit to the profit and loss account, and provision has to be made.
So basically from the query, one can judge that these
I think it depends on whether it is a short-term investment or long-term investment. So today's short-term, I think that the loss or foreign investment value should be adjusted against the profit. But if it is a long-term, I think the treatment seems to be correct.
Yeah, I think very rightly said. And considering the query, since the investment have been made, and in this year itself they have made a profit also of rupees 40 lakhs. This may be assumed to be a short-term current investment itself. So once it is a current investment, then such fall in rupees 36 lakhs should be accounted for. If as provision should be accounted for, and if provision has not been made, then auditor should consider whether any appropriate qualification is required to be made in the audit report. So now query 2, as a statutory auditor of a public limited company, how would you deal with the following situation? The company had subscribed to shares of associate companies amounting to rupees 5 crore. These associate companies have incurred substantial losses and have been referred to the BIFR. Nowadays, not BIFR. This is an old example. For being declared as sick companies. The company does not have, say the company goes to the NCLT nowadays. The company does not want to make any provision for the fall in the value of the investments. So is it correct or not?
It's not correct. As an auditor, I think we should qualify.
Correct. So basically, it is a kind of though it is a associate company, which may be said to be a long-term investment, because if it is an associate investment in associate enterprise, then it may be a kind of a trade investment, and which will be actually a long-term investment. And once it is a long-term investment, then one should see whether there is a permanent decline in the value of the investment. And since the company is there incurring substantial losses and have also been referred to the BIFR or NCLT, so one can say that there is a permanent decline in the value of such investment, and therefore such decline should also be charged to the statement of profit and loss, or provision should be there in the value of such investment. Now coming to the next standard, that is on AS 19. So I would be discussing scope as well as applicability. It does not apply to the agreements to use the land, agreements to use the national resources, then agreement for motion pictures, films, video recording, plays, manuscripts, patents, and copyrights. So to these, the AS 17 does not apply. Then these are the certain definitions which are given in this. So what is lease? Lease is a basically agreement for transfer of right of use, right to use asset for an agreed period in return of payments. So any rental is being received for using a particular asset, then it may be termed as a lease agreement. Then what is finance lease? So in finance lease, where there is a transfer of substantial risk and rewards of the ownership by the lessor to the lessee. So we shall discuss that what are those conditions where it can be said that there is transfer of substantial risk and rewards of the ownership in my subsequent slides. Then what is operating lease? Operating lease is basically lease other than the finance lease. And a non-cancelable lease is a cancelable only on if there is any remote contingency, which is the contingencies which actually is not bound to happen. Then it can be cancelled only with the permission of the lessor, or it can be cancelled when any new lease agreement is being entered into with the same lessor for the similar assets, or it is cancelled on payment of any additional amount by the lessee. So this is called the non-cancelable lease. Then what are minimum lease payments? So minimum lease payments are the payments by lessee excluding contingent cost of services and taxes, but includes for the lessee any residual value which is guaranteed on his behalf. So any residual value guaranteed on his behalf is also considered as minimum lease payment for the purpose of lessee, and any residual value guaranteed by or on behalf of lessee by an independent party. So these are also basically part of the minimum lease payments. Then economic life. Economic life is the period for which economically usable or a number of products and units expected to be obtained. So a life for which actually there is benefit to the lessor in terms of say rupees, in terms of economic. So actual life may be different, may be higher than the economic life of a particular asset. So these are certain more definitions. Unguaranteed residual value. So amount of residual value which exceeds the guaranteed residual value. Then the gross investments is basically the sum of minimum lease payments plus unguaranteed residual value, that is the gross investments. Then unearned financial income is the gross investment minus MLB plus UGRV. Then net investment is guaranteed income minus your unearned finance income, gross investment minus unearned finance income. Then gross rent is contingent rent is lease payment which is not fixed. So this may be contingent on happening of certain event or kind of thing. The next slide is 1 minute. Yeah. So this is important definition, important explanation with reference to the characteristics of the cancellation of the finance lease and the operating leases. So finance lease, a lease is a finance lease when there is transfer of ownership to the lessee at the end, and when there is an option to the purchase the asset at the price which is lower than the fair value, which is reasonable when it is reasonably certain that the same will be exercised. So at the end of the lease period, there is an option available with the entity and with the lessee that it can be purchased by him at a price lower than the fair value of that particular asset. So that may be the case of a finance lease. And the term of the lease covers major part of the economic life of the asset. And the present value of the minimum lease payment amounts to the actual fair value of the asset at the inception itself. And there is unique use of the asset by the lessee that only the lessee can use. So if these conditions are there, then the lease can be termed as finance lease. And in operating lease, it is basically where cancellation losses are borne by the lessee itself. Any gain or loss from the fluctuation in the fair value is borne by the lessee, or any options of continuation for secondary period at the rent is substantially lower than the market value. So how do we account for the operating lease in the books of the lessee first? So in the books of the lessee, operating lease, total future minimum lease payment under the non-cancelable lease for each of the following period. So these are the basically disclosure requirement. and then ultimately whatever lease payments are there, they are charged to the profit and loss along with the minimum lease payments and the contingent rent. So all expenses are being basically accounted for as expense, as operating lease payments in the books of the uh, lessee. And so far as in the books of the lessor is concerned, basically these amount are classified as asset only in the books of the lessor, and the gross carrying amount is being recorded less the any accumulated depreciation or accumulated loss. So the accounting is as good as the accounting for the fixed assets. So that is how the accounting will be done, and whatever payment from the lessee are received are also accounted for as income. And then there are certain disclosures requirement with reference to the future lease payments. The payments which will not be the receivable, future lease receivables, which are not later than 1 year, later than 1 year, and not later than 5 years, and later than 5 years. So this is how it is being accounted for in the books of lessor. So I think there is some, considering the time, as well as I have to also consider the age 26. I'm not discussing much about this, but in case of finance lease, I think I have missed certain slides. In case of finance lease, the lessee will account for that asset as his asset in the books of account, and will actually charge the depreciation on such asset, as well as whatever interest, whatever liability is there on that liability, finance expenditure or interest expenditure will also be accounted for in the books of lessee. And the lessor will account for such asset as the lessor will not account for such asset in the books of account as fixed assets. Rather, it will account for as gross investment in the lease, and on that lease it will be receiving the interest income over a period of, and will be ultimately adjusted out of the lease payments which are to be received from the lessee. So somehow I missed this slide, so I'm really sorry for that. Now coming to the last standard for the day, which I will be dealing with in another 15-20 minutes, is the accounting standard 26, that is on intangible assets. So this standard, the scope of this standard is, it is not applied in the accounting for the various standards which are various assets which are covered by another AS. So the asset like assets which are held by the enterprise for sale in the ordinary course of business. So suppose if any asset is the intangible asset, but these are assets like softwares, so or any other assets in which the company deals with. So in such case, the AS 26 will not be applicable, rather AS 2 will be applicable. It is a deferred tax assets, then AS 12 will be applicable. If it is a leases, then AS 19 will be applicable. And if it is a goodwill, then AS 14 will be applicable. Then any financial assets like debtors, trade receivables, advances. So for that assets, this particular AS 26 is not applicable. Any mineral rights and expenditure on exploration for or development and extraction of minerals, oil, natural gas, and similar non-regenerative resources, this standard is not applicable. The assets arising in insurance enterprise from the contracts with the policy holders, for those assets also, this standard is not applicable. So what are the intangible assets? So intangible assets are identifiable non-monetary assets without physical substance, which is held for use in the production or supply or for rental to others or for administrative purpose. So basically it is a non-monetary asset, but it is identifiable that yes, this is the asset. So the assets like copyrights, patents, licenses, franchises. So these are identifiable the uh, because of say license being granted by the licensors, because of the copyright being registered by the entities with the respective authorities. So these are the identifiable assets, and therefore they are treated as intangible assets. So and on such intangible assets, there has to be a control by the enterprise. So suppose someone has constructed a road, or on that road there is a right of the enterprise to carry on the vehicle. But is that right of way is controlled by the enterprise? No, because the other general public can also come into that road and can use that road. So since such asset, such right of way is not controlled by the enterprise, even though for acquiring that right of way or for by constructing that road, there may be an inbuilt right to use that particular road. But since it is not controlled, it will not be treated as intangible assets by that particular enterprise. Then amortization of the asset is basically the systematic allocation of the depreciable amount of an intangible asset over its useful life. So it is as good as the depreciation for property, plant and equipment. Here the term which is being used for depreciating such intangible asset is the amortization. And then what is depreciable amount is the cost less residual value. So generally in intangible assets, you will find that there are no residual value. So generally the entire cost is the depreciable amount for the purpose of intangible assets. Now residual value amount an entity expects to obtain at the end of the useful life. Then active market is the market where following conditions exist: that the items are homogeneous, the willing buyers and sellers can normally be found at any time, and prices are available to the public. So this is the definition of active market. Then impairment loss, where the carrying amount of the asset is greater than the recoverable amount. So that is the impairment loss. So on this, in fact, there is a separate standard also, is 28 on impairment of assets. Then carrying amount is the amount at which the asset is recognized at the balance sheet date, net of any accumulated amortization or accumulated impairment losses. So simple definition to understand. So what are the recognition criteria when a particular intangible asset should be recognized? So of course, as and when it is being assumed that there will be a future economic benefit which will flow to the enterprise. So then only any intangible asset should be recognized in the books of accounts, and its cost is measured reliably. So an enterprise should assess the profitability of the future economic benefits, whether it will be there or not over the useful life. And it is measured initially at cost. So whatever cost is there for acquisition of such intangible assets, that cost, at that cost it should be accounted for. And if it is acquired separately, then the cost can be measured reliably. Then if it is acquired in an amalgamation in the nature of purchase, it is accounted for in accordance with the AS 14, which says that the accounting should be there at fair value. Then if it is acquired by way of government grant, then it is accounted for at the nominal value or at its acquisition cost. And if it is acquired in exchange of the asset, so in that case, the fair value of the asset, which is more clearly evident at that amount, it should be accounted for. And if it is the internally generated goodwill, then it should not be recognized as an asset. So suppose during the any company during the course of its business over a period has certain goodwill. So such goodwill, internally generated goodwill, should not be recognized in the books of accounts. Yeah. Then the most important aspect of the AS 26 is recognition of internally generated intangible assets other than goodwill. So very important slide is there related to recognition of internally generated intangible assets. So these are the assets when these assets should be generally recognized. So in substance, as and when there is any internally generated intangible assets, it should not be recognized until and unless there is examination with reference to the research phase and development phase of a particular asset. So now, what is research phase and what is development phase, and what are those conditions? So in research phase, if there is any intangible assets, then same should not be recognized, because there is a research. There is no probability that there will be any future economic benefit which will be available to the entity. So what is research phase? So research phase is, suppose some prototypes of a particular asset is developed. Suppose there is a car manufacturing company, and that car manufacturing company is trying to develop a car which is presently, such type of car is not into the market. Suppose presently like EVs are there, electric vehicles are there. So of course today's electric vehicles are there and we all are using. But when there was even no electricity vehicle, and in that case, suppose certain research were going on, whether, and in that research phase there was no idea as to whether such electricity cars will be really successful or not, or whether such electricity car can actually be manufactured or not. Suppose in that research phase, even that was not determined. So whatever expenditure incurred during the course of such research should be charged to profit and loss statement. There should not be any recognition of any deferred revenue expenditure or any recognition of any intangible assets during such research phase. So all expenditures should be accounted for as expense. And in development phase, so development phase starts when research phase is over, and now the entity is confident that yes, this particular product can be manufactured. So the entity starts actually developing the product, and in developing the product, for recognition of the expenditure during development phase, all these 6 conditions should be satisfied. So these are the conditions which are to be satisfied cumulatively. Not that one condition is satisfied and others are not satisfied, and then there is recognition of internally generated intangible assets. All 6 conditions should be satisfied. So what are these 6 conditions? Is that there should be technical feasibility of the asset which is being constructed, then there has to be an intention to complete the asset. Suppose the research is being done for developing a car or for developing, say, in pharmaceutical medicines, any medicine, but at the end there are no intention of the entity to actually complete that entire development phase or complete that product or manufacture that product, then any expenditure which is being incurred in the development phase should not be recognized. And there is ability to use or sell. So suppose now coming to the again example of EV, suppose EV can be manufactured, but its cost is such a high cost that no one will be actually purchasing that EV. So as against say petrol vehicle of 10 lakh, if someone goes for purchasing the EV at 1 crore, so there is possibility that the companies may not, the entity may not be able to sell that to EV. So if such is a case, then any expenditure incurred during development phase should not be recognized. There is an existence of a market for the output. Yes, people are ready to buy it. And then there is availability of adequate resources. So there is all possibility that one has in development phase developed a product, technical feasibility of which is established. There is intention to complete. There is ability. There is existence of the market. But the entity do not have the resources to have the production at larger scale. And because of that, the entity may not be able to actually encash the opportunities of such new product. And there is ability to measure the expenditures, that how much expenditure is actually incurred on the development phase. So when all of these 6 conditions satisfied, so on which date these conditions are satisfied, from that date the expenditure incurred during development phase should be accounted for. So any expenditure before satisfaction of any of the condition out of these six should charge to the expense. So in nutshell, you will find, if you will analysis the balance sheet of the pharmaceutical companies, most of the R&D expense are charged to the expense, because most of the time one of these 6 conditions are not satisfied. So once any condition is not satisfied, all expenditures should be charged to the profit and loss. So that is how one need to actually see the accounting of internally generated intangible assets. So these are the this is the very, very important discussion which one need to consider for accounting for the internally generated intangible assets. So these are the certain examples of research activities and examples of development activities which I have actually tried to explain while explaining the previous slide itself. Then recognition of expense. So expense on intangible assets should be recognized an expense when it is incurred, unless it forms part of the cost of intangible assets, or the items is acquired in an amalgamation in the nature of purchase and cannot be recognized as an intangible assets. Any past expense which has been recognized as expense should not be recognized as an asset. So sometimes company feels, suppose, see, this happens particularly in case of listed companies where quarterly results are published. So many times the query comes that these expenditures are incurred and accounted for expense in the previous quarter, but now since an intangible asset under development phase has been accounted for, so therefore whatever expenditure incurred in the past should also form part of the intangible asset at a later date. So this should not be done. Any expenditures which has been recognized as expense should charge to expense. So that cannot be recognized as an asset. So very important principle which one should keep in mind. Then provisions related to the amortization. So depreciable amount of the intangible assets amortized on a systematic basis. So generally it is straight line method. If consumption pattern is not known, then there is a rebuttable presumptions that the useful life of an intangible asset will not exceed 10 years from the date when the asset is available for use, and then amortization should commence when the asset is available for use. Residual value is assumed to be zero unless there is any commitment by the third party or there is any active market. And on retirement or disposal, it is eliminated from the balance sheets, and whatever gain or losses are there, that is the difference between the net disposal proceed and the carrying amount, should be recognized as income and expense in the statement of profit and loss. So these are the disclosure requirements. The financial statement should disclose the following for each class of intangible assets: the useful lives, amortization rates used, amortization methods, the gross carrying amount and the accumulated amortizations, a reconciliation as we also discussed in case of property, plant and equipment. And then there are certain other disclosures as to the security and amount of commitments and all that. So these are the certain standards which I actually wanted to discuss with reference to the asset related standards. So I'm sure that though there were no queries, but all of you must have actually understood the standards. But many times when queries are not there, there are possibilities that things could not have been understood by the participants. But anyways, yes, Mr. Srinivasa, sir.
Sir, I have a small doubt, like how the internally developed intangible asset will be recognized when the research and development is shared by two companies or more than one company.
No, I could not get you, Mr. Srinivasa.
Can I repeat, sir?
Yes, yes.
Yeah. So my question is that when the research and development expenses is shared by more than one company, so how the like intangible asset is recognized? Which company takes the recognition, or is it a proportionate basis? How it will happen?
Okay, so you are saying that there are two companies who have actually incurred the research and development expenditures.
Yes.
And so far as till research phase is concerned, none of the company will actually recognize, number one. Then in development phase also, you need to see that what is the agreement between these two companies. So as per the agreement, is it a joint intangible assets by them? So if it is so, then it should be recognized by both the companies as per their respective rights in that intangible assets. And so actually you need to take that what is the exact arrangement between both the companies, and accordingly you need to recognize, because otherwise how you will ascertain that how much portion is related to this company and how much is related to that. So what is the exact arrangement between them? So suppose it is a jointly developed intangible asset, so that should be certainly an arrangement between the companies. So basis that the recognition should be there.
Right. Thank you. Thank you, sir.
Yeah. So
Members, any other questions, please? Or you want any clarifications? Or Bhupendra Mantri is patiently clarifying all the doubts from the past 3 days. So thank you, Bhupendra Mantri. So you have taken a lot of pain, sir. Thank you very much for giving us this opportunity to hear you and share your deliberations and expertise knowledge to our members. So really wonderful deliberations you have done, sir, within a short period of, because this covering of 5 accounting standards within this 2 hours accounting standard, 2 valuation of inventories, lease assets and government grants, intangible assets and investments. So you deliberate the length and breadth fully all the accounting standards, 5 accounting standards, sir. So, and also PP also you have discussed it at very detailed deliberations you have done, sir. Thank you. And now, members, if there are no doubts or any clarifications, if you do not require, then I request our Secretary Anirban Palji to propose vote of thanks. Okay, sir, Anirban Palji, sir, please propose vote of thanks.
Thank you, Chairman. A very good evening to all the members. On behalf of the members and the managing committee of the Visakhapatnam branch of ICAI, I would like to thank the learned speaker, Sri Bhupendra Mantri, for having spared his time for the last 3 days and having been with us and shared his in-depth knowledge. We are thankful to you, sir, for your detailed deliberation on the different topics. These standards are really important for finalization of the upcoming audits during this financial year, and the changes that are coming up in terms of the statute and the accounting standards require us to be continuously updated with the standards and the act. And we are thankful for your information and the knowledge sharing that you have had with us over the last 3 days. I would like to thank you very much for having spent your time with us. Thank you so much, sir.
Sir, one thing I want to tell you, sir, Bhupendra ji, the last 3 days, whatever the deliberations you have given, many of members had called to us and given their feedback that they had so much of doubts are removed and ambiguity, and there are whenever they having doubts on the critical points, they got the clarity and they conveyed their thanks to you, sir, especially from our on behalf of our members and our on behalf of our chairman, sir. Thank you very much.
Thank you, sir. Thank you so much.
Thank you, sir. Thank you.
Namaste, sir. Bhupendra Mantri. Will meet you, sir.
Thank you, sir. Thank you so
Thank
much.
you.
Thanks
Thank
to all the members as well as the management committee of the Visakhapatnam branch for providing me this opportunity. And in fact, this also enrich my knowledge because I have to again go to the respective standards and all that. So thanks.
Thanks.
Thank you, sir. Thank you.
Close your-